prior company I was with, Nations Lending, I was with Direct Lenders for the second tour of my career in mortgage, and I can't be happier that I left the retail side and joined the broker side. And the reason is, if you're doing stuff to help people and you're trying to get people into homes and achieve that dream, uh, it doesn't help when you're trying to fit them into a program that doesn't fit them. And so, after talking to customers and hearing, you're really not helping me, um, and having some other weaknesses on display, made the jump last October, and it's been great ever since. And it's been kind of a trying time for mortgage companies in the past. 23 was horrible. 24 wasn't much better. 25 has done a lot better. But at the beginning of 25, the statistic was that less than half of the licensed loan officers renewed their license coming into 25. So that's a significant rate of attrition for lenders. Now, for those of us who are still in the business, that's pretty good. And so less lenders is a good thing. But the biggest part of it and the best part has been being able to fit a loan into somebody's life. Where are they? What do they need as far as help? And we have some very good and capable lenders here. So this is not, this isn't competition with the ladies here and the bankers that are here. We offer programs in the non-qualified mortgage space. So they're not going to be insured by FHA or Fannie Mae or Freddie. The government isn't going to have that insurance. For that reason, you're not going to have, in a lot of cases, in this one case, primary case, debt to income ratio. So what I brought in today is something that I was just sharing. I'm working on a 7th DSCR program loan since May. And the thing that excited me about it when I was with Nations Lending, they rebranded it. It was rental income only because you can't explain it, people don't understand. And so the challenge has been, how do I explain it so people can understand? And they did it with rental income only. That leaves a big gap as far as logic goes. DSCR stands for debt service coverage ratio. And we've heard debt service in the news here lately because of the shutdown. And are we going to be able to service our debts? Will we be able to pay our bills? So debt service refers to your mortgage payment on the mortgage. That's your debt service. You have to take care of that each and every month. The coverage ratio refers to the rent. So if that coverage ratio is 1-to-1, so you have a mortgage payment that's $1,000, you charge $1,000 for rent. I don't care how much you make. I don't need to see any debt to income ratio. I don't need any W-2s. I don't need any pay stubs. You're covering your mortgage payment with the rent payment each and every month. And we set that with either a lease that you have in place already, or we do an appraisal that sets that rent schedule. So once that's done, all you have is you lease the place. And when the ink is dry, a lot of times people need to get in there and do some renovations and stuff like that. So there's not going to be that immediate, we need to see a tenant. It's just, you have a mortgage now. And it just closed on a duplex in Colonial Heights that we had to push back on the appraisal because they took into account that one guy had been living there for 10 years without an increase in rent because he cut the grass. The appraiser shouldn't be talking to people, and they were talking to him. And he told them that, so they shorted us on the rent. Mm-hmm. So we had to push back on that. And it was fairly obvious what I, said, here's the problem. And the appraiser said, I don't agree with you, but I'm gonna give you what you want. I don't care how we get there, just give me an appraisal that's accurate. So, with DSCR, this is just gonna be the general kind of things, how they all generally work, but we offer 4 or 5 different flavors. And one of them allows for a first-time home buyer. I have 2 brothers. Back in May, one was 21, the other was 24. They live at home with mom and dad, and they bought a home in Henrico County and have gone in and renovated it. They've got a really good talent for being able to see what needs to be done and then doing it. They're fearless. And they bought their first investment property living at home with mom and dad. And so that was the thing that excited me about the SCR, is that you can be a young investor. You don't have an SDAG. You don't have the income that you accumulate over 50 years of working someplace. So you're making all this money. You can still start your investment portfolio. And you can be making 30 grand a year. Because it's not coming out of your pocket. It's coming out of the renter's pocket. That's how the ratio works. You're still paying, but they're paying you. And the idea is to charge more than the mortgage is worth. That's going to get you better terms. We do have no ratio DSCRs, and those are your short-term rentals. So if you have a beach house, you're not going to rent it the whole year. You may, but the idea is to get it during the season. You make your money during the season, and then you can stay there during the winter if you want to, however it works, whatever works best for you. So now we're getting to where we can help more people, own homes and earn money before they get out of bed. Because this is all about passive income. We have 1 to 4 units, the DSCR, up to 85% loan to value. So that means you only have to put down 15%. You see all the particulars there, 75% for cash out. And this is the other exciting part about DSCR. In Petersburg, we have homes that are just sitting there. It's either people don't know what to do with it, the relatives who survived the death of the person who lived there don't know what to do with it, don't want to get rid of it. With DSCR, you can take even the house that you are living in now and refi it into a DSCR. And now we're looking at you could get 75%, so you could pull out 25% for cash out. And then you're renting it out, and you're not having to pay that mortgage back. So you can keep the house, convert it to a DSCR loan, rent it out, and you can go on and buy your house and not have your debt to income ratio be affected. So that's a big win for people who are looking to build retirement or to have real property and build equity in that. So what these kids are doing, they now want to buy a $750,000 house up in Goochland for their family. Still live at home with mom and dad. Have a brother, 3rd brother. And so I told them to do that. This is another interesting thing I've learned since being with a broker that we couldn't do with retail. I don't know if anybody has had an FHA mortgage. I guess it would be conventional wisdom. You can only put so much on a FHA mortgage. My thinking was you had to put down at least 3.5%. That's mandatory. But you could only put down 10% maximum. That may be the case with retail. These folks are able to put down $250,000 on this $750,000 house on an FHA loan, because there's no regulation that says they have to put down less than 10%. So what they're doing is they own a house in Richmond. They bought it for $125,000. I just got the appraisal back. I had run the numbers on it. They were going to have to get $335,000, $100,000 in appraised value of that house that they bought for $125,000. We got the appraisal back 2 days ago. They're getting $334,500. That's a nice little chunk of change that they have made. They're using that 250, well, 200 and whatever it is, 46, 500. They're using that as a down payment on another house. They own another home. They own another home in Ashland. They have a tenant. Have had a tenant there for about 2 years now. I'm doing another DSCR on that house because they want to have the cash on hand to do what they want to do, which is probably going to be buy another house. Okay? So helping these guys is creating this relationship where they said they want to have 50 homes by the time they're 50. I want to help them every step of the way, and they're on their way. So right now, these kids living at home, 21, 24, sold a house, a condo in Florida, used the funds from that to buy the house that they're pulling the 250 out of. Then they bought a house from me back in May. They got a renter in there. They have the house in Ashland. They've got a renter in there. And they're able to pull equity out of all these places. And they can do a DSCR, cash out refi, no income, no taxes, no W-2s, don't care. All I care about is, do you have the money to close? And do we hit the ratio on the rent? That's it. Now there's some documents that are going to be going back and forth, of course. Lease agreements, appraisals. That's really where the hiccups can occur is with the appraisal. Because every appraiser is different. They may not know the market. There's a lot of appraisers that are getting into the business, starting out. A lot of appraisers went away. And so they may not know the market like they should. So I just got an appraisal back for a customer in Alexandria. A condo 8 miles from downtown DC. And they're coming in at 0.93. So we're looking for 1 to 1. It's 0.93 to 1. So I've got to push back on another appraisal. And we think we can. They shot too high on the HOA. So there's things that I can do to make things work better at that point. But this lady just moved out of the condo, her and her family, bought a house in Fairfax County, and now they just want to tap into the equity to make renovations to the condo and then rent it out. So this fits the bill, and they're at like 61% loan to value. So she's getting great terms, and the rates are around 6.5% right now. So not bad. They're probably a little bit higher than conventional. FHA rates got as low as, it was 5.107 2 weeks ago. The rate cut, actually rates increased. That was expected, but they've started to kind of trend back down. I don't know if y'all have been seeing any of that stuff. It doesn't make sense. A lot of times now we're seeing inflation ticking back up, so we don't know about the other cuts. But with this, with investment loans, not so much rate conscious as income conscious. So I'll pay a higher rate if I'm going to be getting income from this property. And as the equity goes down, or increases rather, the balance goes down. Now you have the ability to use that money for other things. And I always recommend setting up an LLC. It gives you that layer of protection, liability. That brings in some other, LLC has to be experienced. So you're going to find where you're going to have an LLC that needs to have 1 year experience running. With an individual, I have a lady in Norfolk who's going to buy a house for her sister who is paying too much living at the beach, taking care of, she's a caregiver. So she's going to move back to Norfolk closer to her sister. And her sister just said, I want a $1,500 a month payment. So I told her what she can look for. That's going to buy her a $260,000 house. And she's going to put her sister in. Her sister's going to pay her rent. She's going to do a DSCR. She has a mortgage payment. If she didn't have DSCR available to her, she would have to come out of pocket. And the debt to income would factor in. And she may not get the house. So with DSCR, now she can buy the house for her sister. Her sister will pay the rent. And I'm still not seeing any income docs and no W-2s, no taxes. So it was perfect for her. This is not a reverse mortgage. So a reverse, you don't have mortgage payments. You still own the home and you live in the home. This is for homes you don't live in. This is strictly for investment property. It's not a second home, not a primary residence. So as long as you want to buy this house, you can even go, what I do for borrowers, a realtor, and I've got one waiting for me, I got to look up. He said, hey, this guy wants to, was thinking about putting an offer on his house for an investment. And so he gives me the address, and I have tools that I can pull up things and get expected rental income. I mean, anybody can really do it. Just go to, any kind of Google site that is apartments.com, anything that has rental, AirDNA sometimes. But there's ways that I can figure out what he can expect for rent from that place, and then tell him, yes, you'll cover it, or no, don't go anywhere near this. And so that's again a little added step that we can do that would not have been, it would have been frowned upon. This is not so much get the loans in, get them out. One of the things that I was told at my last place that really bothered me I was helping a guy get a house because he was divorced and he didn't have a place to bring his kids. He was living with a friend. He had to drive a long way to work, and he had the money. He's made great money, but he told me a new story every single day. And there's a saying, buyers are liars. And I was told that every single day by my boss about this guy is taking you for a ride. And he never talked to the guy once. And so I said, he's not taking me for a ride. He might be trying to outthink me or get ahead of things that he really shouldn't be thinking about, just to answer the question or provide the document. Don't be thinking about why. Don't try it. He told me, just for an example, I asked him where he got the money for his earnest money deposit up front. He said, my boss gave it to me. Good. Okay, we can work with that. How did he give it to you? He said cash. All right, we can work with that. It's getting more difficult. And I'm not kidding you, 5 minutes I had a photo on my phone of the check that he got. So that's the level of lying that I was getting. And it was happening all the time. So we worked through it. And but my boss was saying, he's lying to you, you need to get rid of him, it's fraud, you can get out of this easy. We closed on a $377,000 house. It took just about 90 days. And, oh, that was another thing. The boss that wrote him a check, he failed to disclose, had sold the business that he was still working at. And when I asked him for the offer letter, because he made it sound like it had just happened, this was in late July, the offer letter was from May. So just over and over and over. But we closed it, and it was just where I am now. These folks were like, how are we going to make it work? And my boss thing was, you need to drop this guy. And his kids were over there telling him what they were going to put up on the walls and all that. I mean, they were, so no, we weren't getting ripped off. And it's insured. It was an FHA loan. So I just, that did not compute. And so anyway, I just wanted to share with you all today, we have the different flavors. The 1-4 unit, that's going to be your general single family residence. That's going to fit in that one. We have the different loan to value ratio options. We have the 5-to-8 that go up higher. DSCR non-warrantable condos, that's a tough nut to crack sometimes. The condo situation, you have warrantable and non-warrantable. And non-awardable condos are usually, don't touch them, but you can with these. And then the I-10 DSCR, so folks who don't have social security number, stuff like that. Yes, ma'am.
If this is not a reverse mortgage, is this another variation of no doc loan?
No, it's a, I guess you could say it's a low doc loan, but no doc is gonna be subprime,
Oh.
and I wouldn't touch them with a 10 foot, 500 foot.
And
Yeah,
also, I see on here that the documentation is not taken from personal, but the 640 FICO minimum, is that from Dun and Bradstreet?
no, ma'am, even with an LLC, so the way that was, and thank you for asking that, because with an LLC, you're still gonna have members. And so with, like, I'll use the example of two boys that I've had. We get credit bureau scores on both of them. They're the only two members in the LLC. And in some DSCR programs, you only need the manager or the principal member. So it would be their credit. The LLC is just going to be what it's vested in, and that's going to give you that protection from liability. And I just always say, if somebody fell, the ceiling tile came down and hit somebody on the head, you don't want it to be on you. But with LLC, now we're looking at business purpose, but we have to base that credit score on something. And a lot of times LLCs are started up. I know one lady, she wants to buy a house, she starts an LLC. She buys the house in the LLC name, she fixes it up. If it's a fix and flip, she sells it, she's done with it. But she has a new LLC all the time. So you really can't, there wouldn't be a credit history. So the individual is what we have to go by. Good question. But that's effectively it. Um, there's more details. You can see reserves. You're usually looking for reserves, so you have some built up savings. That's going to help you if things go sideways, which they oftentimes do. But I guess the best point about this is you don't have to have a bunch of money to be a real estate investor. You can have the money to get into the loan, but that loan and owning that investment property allows you to convert that equity back into cash and keep it going and keep building. And it's all done without your income being considered. When you get into the lower ratios, that may come up, but not to the extent that we're still back at FHA. So I don't know if there's any other questions, but pretty much that's it. Thank you.